Welcome to this week's update. If you have questions for us, make sure to post them right here. So the overreaching message in your recent market outlook, by the way, we're going to put the video here, was caution, caution, caution. It absolutely was. So what should I be doing instead? Well, when we say caution, 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 what I think we really mean is diversify, diversify, diversify. So here's a chart of correlation matrix versus the returns of a 60-40 portfolio. That's the blue and green dot there. Funny story, it's perfectly correlated to itself. But if we zoom in here, as you get further and further to the left, you get less and less correlated. There's actually the dotted line, that's the zero. Anything to the left of that should be negatively correlated. Negatively correlated means you'd expect it to actually move the opposite direction. As something goes up, you'd expect the other thing to go down. It's our intention over the next couple of weeks to talk about these things because, well, why do we talk about diversification so much? You make money through concentration. You keep it through diversification. So we're planning to start a series where we talk about private equity, private credit, hedge funds, infrastructure, real estate, and one that's not on here, market-linked investments. There are different things that are available to different clients at different levels. I do a short 2-minute explanation on what that is here. But with that, one of the questions for this week is, what about gold and silver? That's not on that chart. Why didn't we talk about that? Well, during our live presentations, we actually got questions on gold and silver both times. And both times we said, hey, we think it's probably a little bit overdone. We're expecting a bit of a pullback. We did not know it would start the next day. I didn't see silver crashing like that. But what it does tell us is, why do you want to own silver and gold? Right? Gold and silver are traditionally fear metals. This is a history of gold going back 50 years compared to the S&P and the Dow. The S&P and the Dow are the red and the blue, and gold is gold, and silver is silver. Their big run up here lately has really made the performance look a lot better, because otherwise it was pretty dismal for a long time. Why do you want to own gold? Warren Buffett said this years ago, if you took all the gold ever mined, you could basically put it into a big brick and you'd spend a lot of money protecting it. But if people are going to pay you what they're willing to pay you for it, you should cut up that brick and buy like all of America's farmland and most of the S&P 500 and timber, and you could buy loads of other highly productive assets that grow and make and create new things, and not just be a big shiny gold brick. 50% of all the gold ever mined has been mined in the last 50 years, and something like 17% of all the gold ever mined has been mined in just the last 10. So we're actually getting even more efficient at mining and creating gold availability. And most of the time people go and sell their gold at local dealers and things, I don't think they understand a lot of it gets sold basically to be melted down and turned back into other bars. And that's true for gold and silver. Silver has many industrial uses, but not a ton. And gold has a few industrial uses, but not enough, and not really at these levels. People look for all their alternatives. It's not really a highly useful metal, right? It's not like, copper we use for a lot of things, but also like oil is a commodity as well, but we burn it to create energy, to do work and create new products and things. Gold doesn't really have that to say about it. It mostly gets, pulled out of the ground, smelted into a bar, and put back in some other place underground. It's not that exciting of a new, holding. When you look back at the 1980s, there was a big spike back then, and prior to that, people didn't think you needed to own metals as part of a portfolio. And then for the following 10 years, every textbook said you should be like 5 to 10% precious metals. When it didn't work for 20 years, all those things in the textbook slowly got whittled away in later editions. And then probably now recently we're going to bring that back. And fundamentally for us, we don't think that gold is a highly productive asset. And if it's not a highly productive asset, why do we want to own it? It's really just speculating that other people will want it later. And that becomes an incredibly difficult thing to guess that other people might want it later. Right? Even just, recently here, if you look back at, just the last few months, we've seen a big break. We've actually seen people like coin dealers say they can't afford to keep any more stock in these metals because they don't want to buy them anymore. And that facilitates a market that might be a little bit overdone. The one caveat to that is people say, well, we got to own gold and silver because of the US dollar, and it's just crashing. Well, here's a chart on the US dollar that I'm going to talk about a little bit. The US dollar index, you look at 1985, that was the peak. That was when Ronald Reagan went to the Plaza Hotel and signed the Plaza Accords to weaken the dollar so that we, as the United States, would export more and not just import everything. If you have a weaker dollar, it makes it more attractive for other people to buy your goods. If you have a stronger or high dollar, it makes us more attractive to buy other people's goods. When people talk about the crashing, right, they're talking about basically the run up from the start of the global financial crisis into like a little bit of the post-COVID era, right? It was a 14-year bull market in the dollar, and now we're crashing from those levels. What I find difficult about that conversation, though, is yeah, we're crashing from 20-some year highs, which is funny to think the global financial crisis is like 18 years ago. But yeah, we're crashing from the 20-some year highs. But if you look back, going back to like 2000, 2, yeah, for most of that period, because there was a big rundown in 2002 into 2003, you're looking at like the last 20 years, most of the time, the dollar index has been lower than it is today. So when people are saying the dollar's getting crushed, it's just terrible, it's usually been lower for most of people's investing lifetimes that they can remember. Why is that important? Well, is it more expensive to buy European wines today than it was 3, 4 years ago? It absolutely is. Is it still cheaper than it was 15 years ago? Yep. It's a relative measure, right? Compared to more recent numbers, it is more expensive to go to Europe now than it was 2 years ago, but it's not nearly as expensive as it was a number of years ago. So do we expect this to be a major conversation? It's always a major talking point whenever you can point to a degradation this quickly. But when you look at a long-term historical valuation, have had a very high dollar recently here for a very long time. And so the idea that it would come down shouldn't be unwarranted. But with that, I'm going to conclude. Easy Money, great read. And hopefully everyone has a wonderful Valentine's Day weekend. And we'll talk to everybody next week.